Mr. Steinman, can you tell us why interest rate differential is important?
Elsabe, it's all about liquidity. I think I've explained in the past that 25 years ago, we had this problem that interest rates had to be substantially higher in Namibia than in South Africa. Why is that? Because we are a so-called open economy. You can freely move money between the South African market and the Namibian market. There are limitations now, but only in terms of reporting. You know how difficult it has become to make a South African payment.
Yeah.
You know, especially for the person who receives the payment to get it released on that side. But it's not as if it's blocked. It is just keeping a record of the value of all the transactions that happens between the two countries. And this is part of the whole financial intelligence jack-up, because that's the reason why we got grey listed. And when we improved that, that's also the reason why a week ago we were ungrey listed. You know, and I'm sure you've heard about that whole thing.
Yeah.
But you and I had this nonsense of KYC, know your customer, and then you have to go do it 3 times over and over again every second year at the bank. You know, it became a bit ridiculous. But hopefully that's now behind us. So if you look at what happened 25 years ago, if the interest rates in Namibia did not provide a premium in the return on investment for large institutional investors, the money flowed to the South African market. So it means that there had to be a sweetener. There had to be a good reason for the big pension funds and the big life insurers to bring a part of their money to the local market. And the thing that rewarded them was the higher interest rate. Now remember, institutional investment work on time frames of 10, 20, 30 years. Very long. So you may think that in those years the difference was actually about 2%. Now lately we're talking about half a percentage point and a quarter of a percentage point. You know, so it's become very, very small. But also, in all honesty, I have to tell you that interest rates, the bank rate at that time, was in the region of 16, 17, 18%, even went up to 21% for a very short while there in the early 90s. So in relation to the bigger amount, the 2% higher interest rates in Namibia were not that excessive, but you felt it. And at times when the differential became too small, then the local banks had serious liquidity problems on a daily basis. If you crunch the numbers and you look at the stats, then you will see that for the 3 big banks with South African parent companies, it wasn't really an issue. You know, if FNB is short on that afternoon's liquidity requirements in terms of the Banks Act, it just got a transfer from the parent FNB in South Africa. And the same with Standard Bank and Nedbank. You know, it was immediate. The one that suffered was Bank Windhoek, because it did not have the South African parent. It was local shareholding. You know, and a bank, the operations of a bank, you can't go and knock on the door of every shareholder and say, "Hey, come pay $1. We are short." You know, it becomes unmanageable. So what happened since then, and I'm talking now since the very late 90s and the year 2000, 2001, is that you saw gradual reduction in interest rates. Not only here, but across the world, you know. And that was a function of the integration of markets. And it was a huge thing, and this is what's been upset in the last 2 years. And it's also the reason why interest rates have become important again. Is it clear, the point I'm trying to make, that interest rates gradually came down from the region of about 18% over a 25-year period to where they were just before COVID, 7.5% in that area, 7 to 8%. point I'm trying to make is that we are in a much lower interest rate environment now than what we used to be when local liquidity was a problem.
Yeah.
Now the second aspect, a very important aspect, on top of liquidity now, is that if you look at confidence in the local capital market, it's very high. And where you see this in the yields on the government bonds, especially those government bonds that are aged under 12 years. So the shorter end of the curve, we call it, and those yields have been steadily declining. 3-4 years ago, or during COVID, I would say the going rate there, depending on the maturity, was between 9 and 12%. Now, a week ago, I saw in that announcement for one of the new issuances that the indicated interest rate was 6.75. Now, that is about half what it was 10 years ago. So what has happened is, as the local capital market has matured, the confidence in the instruments has also increased to the point where confidence in Namibian investments today are very high. And the only thing that we need to consider is the maturity, how long or how short a government bond will be.
And we will come back with an interesting question to answer that question.